Everyone, I hope you're all doing well. Now, in today's lesson, I'll be taking you guys through understanding market structure and identifying structural breaks. So let's get straight into it. Now, I'm going to give you guys a quick, brief introduction to smart money trading. Welcome to smart money trading, a style of trading where we incorporate institutional concepts within our trades. This allows us to have that edge in the markets. Now, I will guide you through SMT and help you understand and identify specific market behaviors that will allow us to trade and invest in harmony with market manipulation caused by the smart money. Essentially, we already know that the big institutions are the market movers. They trade with such volume that doesn't even compare to 0.0000001% of the amount of volume us retail traders trade. A good anatomy that my mentor, Mark Fraser, taught me is that you got to think of it as this. The smart money are essentially the sharks, and we as retail traders are the remora fishes. Now, the remora fishes would follow the sharks and eat the sharks' leftovers. That's a good anatomy to think of it as. Now, let's get straight into it. Keywords I want you guys to familiarize yourselves with is smart money. Smart money is a word to identify the market movers. So when I say smart money, I'm referring to the big financial institutions, such as the hedge funds, institutional banks, etc. Goldman Sachs, JP Morgan, all of that. Mitigation. Mitigation, you're going to hear me using that word quite a lot in the next lesson when I teach you guys all the blocks. Essentially, all it means is that this is where smart money break even on their losing position. Liquidity. Liquidity is simply an area where there's a lot of stop losses and pending orders. Equal lows and equal highs is just an area where price has reached twice or more and reversed, such as support and resistance levels, double tops, and double bottoms. So let's get straight into it. Market structure. Structure is perhaps the most important aspect in trading and analyzing the charts. By having a good understanding of market structure, that alone would elevate your trading beyond belief. So in this lesson, I'll be going over the different types of market trends and structural breaks. Now, these three basic market movements are comprised of 4 swing points. Now, before I get onto that, let's identify these 3 basic market movements. One, we have a bullish sentiment, which is referred to as an uptrend. It's when price is printing a series of higher highs and higher lows. And then we have a ranging market. Is when price is printing equal highs, equal lows. Essentially, you can call it support and resistance levels. Support and resistance levels. Is when price is just doesn't really have a direction, it's just moving sideways. A bearish sentiment, referred to as a downtrend, is when price is printing a series of lower highs and lower lows. So like I said, these basic market movements are comprised of 4 key swing points: higher highs, higher lows, and lower highs. Now, if you aren't already familiarized by these key swing points, I'm going to go through them with you. So in an uptrend scenario, this would be our lower high, right? So when price pulls back and then impulses, it closes above that recently created lower high, therefore creating a higher high. Now, same thing that goes for the lows. This was our lower low, essentially the lowest phase of the move over to the upside. But when price impulses and pulls back, it closes above that low, therefore printing a higher low. Does that sort of make sense? Now, and again, for a downtrend, this would have been the highest point, which is the higher high. Price impulses down, creating a higher low, pulls back, but closes below that higher high, therefore leaving us a lower high, and then so on, so on. Price impulses, closes below this low, therefore creating a lower low. Now, if I just show you an example on GU, right over here, we can clearly see price is printing a series of higher highs and higher lows, right? So as we can see here, this was a lower high, then we have a lower low. Price impulses over to the upside, closing above this lower high over here, therefore printing a new higher high. When price then pulls back, it fails to close below this low, therefore creating a higher low. And then price impulses over to the upside, closing above this higher high, therefore creating an even higher high. And then so on, so on. And then this is an example of a downtrend. Price creates a higher high, impulses over to the downside, creating a lower low. Price then pulls back, fails to close above that higher high, leaving us a lower high, and then carries on his impulsive move to the downside, breaking below this lower low, creating an even lower low. Now, break of structure. All right. By using basic principles shown in the recent slides of the basic market movements, you can accurately determine where the buyers and sellers are gaining strength or weakness within the market. So as we can see here, price is printing a series of higher highs and higher lows, referred to as an referred to as an uptrend. But what happens when price fails to maintain its upside presence and actually closes below that recently created higher low? When we identify something like this shows us that the sellers are now coming into power, potentially signaling to us that the market wants to now shift direction over to the downside. Same thing for a downtrend. When price is creating a series of lower highs and lower lows, and price then breaks above the recently created lower high, that shows us the buyers are now coming into power, potentially shifting the direction of the market. So now if I go on GU again and show you an example of this taking place. So as we identified earlier, we noticed that price over here was in an uptrend, right? Creating higher highs, higher lows. But notice this, once we create that higher high, price pulled back and created a higher low, right? Because it failed to close below this higher low. But then once it started to move upwards, it then failed to close above this higher high, which then creates a lower high. And then the move after this lower high closes below that recent higher low. This therefore now prints a lower low. Now once we identify this break of structure, we now know that the market wants to shift direction. And as we can see here, once we got that break of structure, market was now moving over, shifts its direction over to the downside. But then look what happens here. So we now know over at this point over here, we're in a downtrend, right? Because price is creating lower highs and lower lows. But notice what happens here. So this was our recently created lower high. When price moves over to the downside, it failed to create a lower low. It failed to close below this low. But then what did it do? It impulsed above that recent lower high, therefore printing a new higher high. This is then what we identify as a break of structure. So now we now know that the buyers are coming into power. So now once we got that break of structure, what do we see now? Price is printing higher highs, higher lows. Now if I just zoom into this area over here, we identified that we were in an uptrend, but now at this point over here, what does this look like to you? A ranging market. Price is simply creating equal highs and equal lows. When you have a scenario like this, I personally stay away from the charts until I get a break of structure to either the upside or to the downside. Once I get that break of structure, that's when I start to look for buy or sell opportunities. Trend reversals. Now I'll be taking you guys through break of structures with signals towards a continuation in trend. So as you can see right over here, price is clearly printing higher highs and higher lows. Now, how do you know price is continuing its move to the upside? Once price creates that new higher high and prints that higher low, and then it impulses above that recently created higher high, that is identified as a break of structure. But this is identified as a break of structure which signals a continuation in trend, because it shows that price is still, the buyers are still in power, as none of the lows were broken, only the highs were broken, which allows us to look for opportunities to buy into the market. So as you can see over here, we had that break of structure, right? Price then pulls back. I haven't been through all the block or supply and demand trading with you guys yet, but as you can see here, once we got that break of structure, price then pulls back, doesn't close below this low, but then mitigates this demand zone right over here. We got a nice reaction, price moves over to the upside, and then we got that break of structure. Once we got that break of structure, price pulls back into this demand right over here, buys up again, pulls back, mitigates this 4-hour order block right over here, and then again break structures to the upside. So this is just identifying break of structures, which shows continuation in trend. But once price closes below this low over here, that's identified as a break of structure, which signals a trend reversal. So if I just show you guys an example on GU again, right over here. So, all right, sweet. So once we identify that price broke structure, we can start to look for buying opportunities, right? So this was our recent lower high, lower low, price broke structure, pulls back, and it comes into this nice sell to buy candle right over here. Mitigates, moves over to the upside. Price creates a higher high, pulls back, creating a higher low, and as we can see here, clearly mitigating this 4-hour demand zone. Price then again breaks this structure, this structural high, pulls back, and mitigates this demand zone. Price then creates a higher high, and then so on. And then that's when we got that break of structure, right? No, okay, so before I get to that, so price created a higher high, pulls back. You would have entered at this demand zone right over here. Yes, you would have been in profit. You would have probably been targeting these highs because you haven't had a reason to target anything less, as price is still moving over to the downside. But then once price moved up, it then took you out and then broke structure because it broke that recent higher low. Once you got that break of structure, you then start to look for selling opportunities, right? So if I just zoom into this area over here, probably the 30-minute, we can find a nice entry point. As you can see over here, we have a nice supply zone at this point over here. Go back onto that 4-hour, extend that, and if we play price, so we got that break of structure. We're now looking for selling opportunities. Price pulls back. There we go. We would have entered at this 30-minute supply zone right over here, and price would have moved over to the downside, continuing its bearish sentiment. Okay, so I hope that kind of makes sense for you guys. Okay, so overall that kind of sums up lesson number 1, understanding market structure and identifying the 2 types of break of structures: the break of structure that shows continuation in trend, and the break of structures that signals trend reversals. So I'll see you guys in the next lesson. This is lesson 2, where I'll be going through liquidity within the markets. Let's get straight into it. So, what is liquidity and how do we identify them? So, in simple terms, liquidity is just an area where there's stop losses and pending orders within the markets. Essentially, we are the liquidity in the market. However, that does not necessarily mean all orders must be taken out by smart money, as some areas of liquidity are simply not liquidated enough for it to be worth the grab. Popular areas where retail traders would usually execute a position are areas such as equal highs, equal lows, which is examples of that would be support and resistance levels, double tops, double bottoms. Another popular area would be trend lines, and another popular area will be golden zones. All of these 3 areas are strategies where a typical retail trader would usually execute a position on. Now, what does that mean? That means there are a lot of stop losses at these areas, right? Which, in a smart money's point of view, that is all liquidity that they can capitalize on, right? Now, these areas would most likely have multiple. Again, this is repeating the same thing that I just said. So now these areas would most likely have multiple orders, as many retail traders are taught to buy or sell of these areas. Knowing this, smart money would aim for these areas as multiple stop losses would be set there, which makes it worth the grab. Identify as liquidity within the market. Now, if I go back to the last slide, remember when I was talking about the popular areas where retail traders would usually execute their positions of? Those are areas of what we deem as liquidity in the market. So, we have our equal highs, our areas of double tops and resistance. When we identify these levels, we would mark that out as an area of liquidity. Same thing for equal lows. When we identify double bottoms or areas of support, we'd identify that as liquidity. Same thing for a bear trend. In a retail's perspective, when they identify a trend like this, they'll usually wait for the pullback to touch that trend line so they can sell off again. Same thing for a bear trend. In a retail's perspective, they'll draw out their trend line, wait for the price to pull back to that trend line so that they can buy up again. Fib levels. Once a retail trader gets that impulsive move, they'll fib up the swing high and the swing low, wait for the pullback to the 618 level to then sell off again. And the same thing for a bullish market. So as we can see here, we can identify this very nice support level, right? In a retail's point of view, as soon as price pulls back to this double top right, they would usually sell off. Now that they've sold off at this point over here, they would set their stop loss above a few pips above this level. So now the market moved in their direction. They're happy. Or on the best trade in the world, sniper entry. All of that nonsense. Price starts moving in their direction, and then boom, their stop losses have now been taken out. They've been liquidated. Another example of equal lows being taken out. All of this support level, right? A retail trader would have bought at this point over here. Would have bought right over here. Stop loss a few pips below. Price starts moving in their direction, comes back to break even. They'll buy again, add more liquidating this area more, and then boom, the market makers move price even lower to seek all of this liquidity that's been created. Now retail traders have completely been wiped out. Now here we have a bullish trend, right? So no, if I go back to the first lesson when I was teaching a lot of market structure, without knowing what liquidity is, you could have caught this trade, right? Because look, we have a series of higher highs being created and a series of higher lows being created. What did price do over here? It broke that low. Now once we get that break of structure, what do? We start to look for sell positions, because now we can see that the sellers are coming into the market. Price reverses, mitigates, and we sell off. Okay, but anyways, let's go back to the liquidity. So once we identified all of this trend line being created, right? That is all liquidity in the market, because in a retail trader's perspective, they'll wait for that pullback to buy off the trend line again, right? And then boom, what happened? Liquidity was taken out, structure was broken, price pulls back, mitigates this area of supply, and then continues price over to the downside. This is another example. Price was printing a series of lower highs and lower lows. Now again, without the liquidity concept that I'm teaching you now, you lot could have taken this trade right over here. How? Because look what happened over here. Price was creating a series of lower highs, right? And then boom, we had that break of structure. Once we got that break of structure, what do we know? The buyers are coming into power. Now we're going to have a shift in a market. The market is going to shift into the upside. Price break structure, pulls back, mitigates our order block, and moves over to the upside. But let's talk about liquidity now. So as you can see here, price is creating a very clean trend line, right? As a retail trader, what they'll usually do is wait for the pullback to that trend line and sell off again. And then boom, what happened? The trend line got liquidated. Stop losses have now been taken out. Okay. Fib levels. So as we can see here, price created an impulsive move, right? Now as a retail trader, when there's an impulsive move like this, you'll usually fib up the swing low to the swing high and look to buy off the 618 level. Now look at the 618 level and let's see what happens now. Boom. So our 618 level was somewhere over here. As you can see, it sort of moved over in their direction, and then it took them out fully, and it came to our discounted areas, our 79%, our 79% discounted level, which also aligns perfectly with our demand zone, or you can call our bullish order block, or you can call the sell to buy, right? Charts. So as we can see here, GU, right? What did GU create right over here? A double top, correct? An equal high. Now, when we identify an equal high, what do we know that is? An area of liquidity, right? So in a retail trader's perspective, they would have sold off over here, had their stop losses a few pips above, right? Now, once price starts moving in their direction, they're excited. Oh, look at me, best trader in the world, right? And what ended up happening? Price came to our area of demand right over here, okay? As a smart money trader, I would have bought at this point over here, which I did. And if you go back to, I have a GU market breakdown on my IGTV. You can go and check that out, right? So once I identified that area of liquidity, I knew price was going to pull back into my demand, and I'm going to buy to seek that area of liquidity. Now what happened, right? These were equal highs. What happened? Price moves in the retail trader's direction, gets them excited, and then boom, takes them out. Right over here, what happened? Now let me go over to that 4 hour to make it clearer for you guys. Alright, let me zoom in. Okay, so the same thing happened again. Now, once we got that break of structure and price took out that liquidity, price starts to pull back, right? Now, what did it create? First of all, let me show you. Take out my fib level. Mark out the low. Mark out the high of this swing low and this swing high. Okay, cool. So this area over here is the 618, right? And then let me just take out the 618 fib if I have it. I don't even have it. Okay, cool. But let's just say the 62% is it almost aligns with the 61.8, right? So this area over here is the 61.8. So as a retail trader, they would have looked to buy at this point over here. And also, what can we identify? Look at all of this equal lows, right? This Swix all aligns together. Was that creating an area of support, right? So not only are they buying off a support level, they're also buying off a 618 level, creating even more liquidity, because as a retail trader, that builds more confluences to look for buy setups, right? So they would have bought at this point over here. Price moves in their direction, they're happy, they're excited, and then what happens? Boom, price liquidates them, right? They take out all the stop losses. And before it took them out, right, what did it create right over here? Now, I didn't mark that out, but we can mark it out together now. What is this? A double top, right? Look at how market makers is creating all of this liquidity, right? They're creating all of this liquidity so that when they're moving in the intended direction, they can liquidate in all of this move. So this is liquidity right here. Price pulls back, comes into our 4-hour area of demand, then starts to move over. First, it takes out the liquidity, right? This liquidity is now taken out. And now what does it create? Again, you see the cycle. It keeps leaving liquidity. It keeps creating these equal highs that it then seeks to take out, right? So this double top is now taken out. And what did price do again? It created another double top. What is this? More liquidity. Retail traders would have looked to sell off at this point. Stop losses above. Price pulls back, comes into our discounted. I'll show you now. Demand. This is swing low. This is swing high. Look, it came into our discounted demand, right? So price created a double top, pulls back. Retail traders are happy because they're in profit. And then, boom, liquidity is now taken out, right? The examples keep repeating themselves. Now this liquidity is taken out, price breaks structure. And what does it do? Again, it creates all of this liquidity. This is a nice clean resistance level, right? Retail traders will look to sell off, sell off, sell off. All of these touches that keeps touching is liquidating this area more, right? So now that this liquidity is, this resistance is now formed, retail traders are selling, they're happy, they're in profit now, right? This area of support is created, the area of support is now taken out, it's liquidated, retail traders are still in sales at this point over here, price comes into our 4-hour sell to buy candle, our order block, and what does it do? Boom, takes out all of the stop losses that was set over here. Retail traders are now out, and our smart money traders are in at this point over here. And it goes on and on. The examples, let me show you, let me see if I can find more examples on any pair. E.g., go to current. Right over here, right. So, let me go into the lower time frame to make it clearer. Sweet. Now, when I took this sell off from here, right? Now, let me just replay price for you guys. Alright, there we go. So, why did I take this trade? First of all, we got that break of structure, right? It broke structure. Price was creating higher lows, and then boom, we got that break of structure at this point over here, right? That was my first confidence. Confidence number 2. What can we identify at this level over here? Just remove that. Look at all of this. This is a very clean double bottom, yeah? An area of resistance. Now, what is that? Liquidity, yeah? What's this over here? A double bottom, even more. Liquidity. Oh, let me go back. Let me just remove that. Hey, oh, forget that. Let's keep that X there. Yeah? So not only do we have this double bottom over here, we also have this double bottom over there. And what's that? More liquidity that needs to be taken out, yeah? So once price pulled back to my order block, after I got that break of structure and identified these areas of liquidity, I knew for a fact that EG was going to drop and seek this liquidity, right? And let's see what happens. Liquidity number 1, taken out. Let's wait for it. Boom. And you see this area of liquidity that we had marked out? Price took out our first area of liquidity, and now it's taken out this second area of liquidity. Now, once it took out that area of liquidity, look, watch this, guys, yeah? This is current market conditions, right? I have this area marked out. It's a very nice supply zone, which also aligns perfectly with my discounted area, the 79%, right? So I'll be looking to sell off of this area over here. First of all, my first confluence is that it broke structure, right? So continuation in trend. 2, we have a discounted demand over here. 3, look what it left down here. Liquidity. Yeah? Notice how market makers will always create these areas so that they can capitalize on these areas, right? So as a retail trader, they would have bought of this little double bottom. But what's going to happen? Price is going to, they're happy, they're in profit, whatever. Price comes into our area of supply, and then boom, we'll seek to take out that area of liquidity. So I hope it's all making sense to you guys and it's all coming together. 3, where I'll be teaching you guys the order block concept. So let's get straight into it. Order blocks. One of the most important concepts within this strategy is the understanding of order blocks. An order block is an area on the chart where we can clearly identify a large order being placed on the market. You notice the order being placed and then a rapid move away from that area, which usually tends to break structure. The candle before that rapid move is what we identify as our order block. Now these are essentially areas of supply and demand within the markets. So here are 2 examples of what we would identify as an order block. So as you can see here, this is the last sell candle before a rapid move to the upside. So that sell candle is what would mark out as our order block. Now when we mark out our order block, we mark it out from the open to the close. Yeah. However, I know a couple traders that tend to include the wicks. So whatever you see works best for you when backtesting this strategy, go for that. But me personally, I mark out my open to the close, right? So how we trade it. Once price moves rapidly away, we identify the last candle and we mark it out. We then simply wait for a retracement back to this order block where it would mitigate the open of this sell candle so that we can catch a buy over to the upside. And that's the same for a bearish example. We have a buy candle and then a rapid move to the downside. We then wait for price to pull back and mitigate the open of that buy candle so that we can ride the sell. So let me show you guys live examples. Now in this case over here, we have identified a nice break of structure, right? Now once we identify our break of structure, that is when we start to look for our order block. Once we got that break of structure, we simply look for the last down candle before the rapid move to the upside, which broke structure, right? Now, as you can see, this was the last 4-hour order block right over here. Essentially, you can call it the sell to buy candle. So what we mark out the open and the close, and then we wait for price to pull back. Now, once we got that retracement back to that order block, that is where we get in our entry. So we'll enter here with our stop loss at the close and catch the move over to the upside. Now, a bearish example right over here. We have this was the last low. Price broke through this low, showing a continuation in trend, right? And as you can see, this was a very rapid move right after this last candle. So we would mark out the open to the close, right? Wait for price to pull back to fill in any imbalance and mitigate the open of that candle. As you can see, price pulls back, would have our entry at this area over here and our stop loss at this close. Once we enter here, we then set our TP wherever it was intended to go towards. So I'll personally target this low, or if there was any further imbalance or liquidity that needs to be taken out, I'll target those lows. But the whole point is to understand how we would enter the markets. So that's basically it for order blocks, but I'm just going to go through a quick example with you guys before I move on to lesson 4. Let's just stick to EG, and let me show you. Let me just clear up the chart. Actually, let me go to a fresh one. Euro GBP. There we go. That's a clean one. Now let's head over to that 4-hour. Sweet. Alright, so the trade that I caught was this one right here. Why did I take this trade? Now it's pretty straightforward, right? This was the recent low. That low got broken. And not only that, we had our liquidity down there, right? Now, once we had that break of structure and that liquidity was created, right? And there was a rapid move to the downside right after this bullish candle. Meaning, what I would personally identify as my order block would be this 4 hour. You can call it a buy to sell candle, or you can just call it your bullish order, bearish order block. Now, as you can see, price broke structure, left us some liquidity that needs to be taken out. We then waited for our pullback, and then we got in the pullback right at this area over here. And then what do? We sell off right here with a stop loss at the close of the candle, and you can target the liquidity, or in my case, I'll be targeting these lows. Reason being is because if you zoom out, we have all of this imbalance, which I'll be teaching you in lesson 4. But essentially, I would like all of this imbalance to be filled in. And now that you lot understand the order block concept, right? Now, what do we have over here? We have a break of structure, right? Now that we have that break of structure, this would be deemed as our order block, right? So what I would be looking to do is, I'm going to sell currently. I'd like to sell it down to this order block over here to then buy it up again, okay? But that's just the basic concepts of order block.
Examples of trading order blocks on a live chart. Now let me actually clear up this chart for you guys, and let's get straight into it. So, how I took this trade and why I took it. Let's ignore that for now. Clear up the chart. So, first things first. Price was in a downtrend, right? Price was creating lower highs, lower lows, and that was our most recent lower high. Okay, so at this area over here is where we got in our break of structure, right? This is where the break of structure happened. So if I write that down, break of structure, and as we can already see, price left us some sweet liquidity, equal highs right up there. That needs to be taken out, right? So now that we got our break of structure, and there was liquidity above there, right? And there is all of this imbalance and inefficiency that I'll be teaching you in lesson 4, by the way. But there's all of this inefficiency that needs to be filled in, and this liquidity that needs to be taken out, and this break of structure to show that the buyers are coming into power. So with all of these confluences, that's when I know I should start to look for a buying opportunity. So we got that break of structure. We then look for the last candle before that rapid move which broke structure. And in our case, we can clearly identify this very clean sell to buy candle. Now remember when I told you, when identifying buy to sell or sell to buy candles, it's important that the candle is mainly body and minimal wicks. In this case, you can see the candle is mainly body and just a minimal wick up there. So we'll mark out the open, like so, and we'll mark out the close. We'll extend that. Now, once we identified our order block, we then wait for price to pull back into the order block, and then we'll get in our entry. So we would have entered at the open of our order block with our stop loss at the close, and then our TP will be that liquidity all the way up here. So that's an example of a bullish order block. Now I'm going to show you guys one more example of trading Euro USD and identifying bearish examples. So let me go to my chart because I've already marked it out for you guys, so it's easier to explain. There we go. So let me take all of this off. Alright, sweet. So as you can see here, price is printing a series of higher highs, right? And a series of higher lows. Now, as you can see here, that was the most recent higher low. Now, what happened at this point over here? Price broke that structure, right? That was the most recent higher low, But now price broke that structure, creating a lower low. Once we identify that break of structure, what do we then look for? The last candle before that rapid move which broke structure. And in that case would be this very solid buy to sell. We then mark out the open and then we mark out the close. Just try to be as accurate as I can. There we go. And we'll mark out the close. And then we simply waited for price to pull back so we can sell it off. So we'll enter at the open, have our stop loss at the close, and we can set our TP at that low. Alright, that'll be trade number 1 complete. Now, trade number 2. Once we got that another break of structure, which shows a continuation in trend, yeah, shows that the buyers are still in power. Once we got that break of structure, we look for the last buy candle before that rapid move, which again broke structure. And as we can see here, we identify this candle over here. Now this candle is not a buy to sell or a sell to buy candle. It's an indecision candle, which marks out an area of supply. Now when we have a candle that looks like this, where the body is minimal and then the wicks are bigger than the body, we identify that as our indecisive candle. In this case, we'll mark out the wick to the wick, yeah, and we'll enter at the wick. So we'll sell off here. But in an example of an indecision candle, you'd have your stop loss 5 to 10 pips above that zone. So if we mark out 10 pips above this, that would be right over here at 22244. Cool. So we'd have our stop loss at 222. There we go. We'd have our stop loss here, and we'll again target these lows, right? So you'd have gotten 2 trades using these examples. Yeah. So I hope you lot understand the concepts, and I hope it was pretty straightforward with you lot. And if you guys have any questions, feel free to directly message me or just message the general chat. I'm sure other students will be there to help as well. Alright guys, I'll see you on lesson 4.
Alright, what's going on everyone? Hope you're all doing well. So today we'll be moving on to lesson 4, where I'll be going through market inefficiency, other words, imbalance, fair value gaps. They're all the same thing, just different names. So let's get straight into it. Market inefficiency. When looking at efficient price action, we notice that all wicks meet. What it essentially means is that when price is moving over to the upside, both the buyers and the sellers have a fair chance at access to liquidity to continue the wave up. Now, if you take a look at inefficient price action, we notice that wicks don't meet. This therefore means this move had a lot of buying power, which has created that imbalance. So, let me show you an example here. Inefficient price action. In this case over here, we can tell that there has been a lot of selling power. Why? Because the wicks don't meet. Whereas this example here of efficient price action, when price is moving over to the downside, we know that there isn't too much selling power because the wicks are meeting, right? So this is the first wick and the third candle. This is the first candle and this is the third candle. The third candle's wick, if it meets the first one, that means it's efficient price action. But in this example here, as you can see, the first candle's wick, it doesn't get met by the third candle's wick. There's a gap. That gap is what we call imbalance, inefficient price action, fair value gap. They're all the same thing. Now, in a bullish scenario, there's a lot of buying power in this case here. So the first candle's wick doesn't meet with the third candle's wick. This creates a gap, an imbalance, or fair value gap, inefficiency. In this example here, market is moving over to the upside. However, the candles are meeting. This therefore means it's efficient price action. There isn't any imbalance, right? So now if I go back and I read over it again, I hope it makes sense. So when looking at efficient price action, we notice that all wicks meet. Just like the example here, efficient price action, the wicks meet, right? Now what that essentially means is that when price is moving over to the upside, both buyers and sellers have a fair chance at access to liquidity to continue the wave up. Now, if you take a look at inefficient price action, we notice that the wicks don't meet, just like the example. the wicks don't meet, right? This therefore means that this move had a lot of buying or selling power, which has created that imbalance. However, when you identify inefficient price action, keep in mind that price comes back to fill in any imbalance, to provide both the buyers and sellers a fair chance at liquidating the market. However, this does not mean every imbalance will always be filled, okay? Keep that in mind. Now, if I head over to some examples right here. What is this? Imbalance. Why? This wick did not meet with this wick. Therefore, there was a gap, an imbalance, inefficient price action. But notice when price starts moving over to the upside, when it pulls back, what does it do? It pulls back to fill in that gap, right? Now, this is what we classify as efficient price action because this imbalance has now been filled. Makes sense? So when you identify any imbalance in the market, expect price to pull back to fill in that gap, right? Now look at this example. What is this? Inefficiency, right? This is an imbalance. Why? This wick did not meet with this wick. So expect price to pull back to fill in that gap, right? So notice how price pulls back, fills in this gap before it continues over, right? So efficiency is quite straightforward. There's not much to it. It's simply when the wicks don't meet and there's a gap created. This therefore represents that there's a lot of buying, in this case, a lot of selling pressure. So when price wants to pull back, it will fill in any imbalances. Right? I hope that makes, and I'm going to quickly show you guys an example before I move over to lesson 5 because this is fairly straightforward. Now GC, this is one of the trades that I sent over on the Discord, right? Now, in terms of this entry here, what do you guys notice here? Okay, so let me remove this order block. But look at this. Look at this wick. Let me zoom into that. This wick and this wick don't meet. So what does that mean? That from here to here, all of that is imbalance, right? There's a lot of buying power. What is this? Imbalance. What is this? Imbalance. This imbalance, again, pulled back and it got filled. But there's all of this imbalance down here and here that needs to be filled, right? So, when price moves over to the upside, right? What do we expect price to then do later on? We expect it to pull back to fill in these imbalances, right? And look what it does. It pulled back and filled in that imbalance. But there's still imbalance down here. And there's an order block that's left unmitigated. Now, this is what I want to now make you guys understand. When identifying an order block, you look for an order block that has imbalance above. This therefore means price will pull back to fill in that imbalance and then mitigate our order block. So essentially, I now have identified that there is imbalance at this area. And we have also identified an order block, right? So now what do we expect price to do? We expect price to pull back to number one, fill in this imbalance, and number two, mitigate this order block. And now if I stretch everything back, what do we notice happened here? Price has now impulsed and pulled back to fill in all of these imbalances, right? And then what did it do? Mitigated our order block. We now go long at this point over here. Oh. And in terms of TP, we'll look back for any liquidity and we can clearly identify a double top right here. So in terms of TP, you'll target that high there. Why? Because there's liquidity, right? Now, in terms of this re-entry here, very straightforward. What is all of this here? This whole entire area from there to there. Imbalance, right? What was this here? From this wick to that candle. Imbalance. But what happened? Price pulled back. It filled in this imbalance. But what's here? More imbalance. So, when price pulls back, it filled in that imbalance, right? And not only did it fill in that imbalance, it then mitigated our order block. As you can see, price tapped us in, we move over to the upside, right? And more examples right over here. This move here, let me remove that rectangle for you guys. This wick didn't meet this wick. So what does that create? Imbalance, right? So we now know from this point here to that point there, price must pull back to fill in that imbalance. And it done that right over here. Now, in terms of mitigating our order block, it pulled back to fill in the imbalance, but it didn't mitigate our area of demand. And what do we expect? Price to pull back, mitigate that demand, to then continue the move over to the upside. And let me go show you guys further examples. AUD and ZD, right? Perfect examples. Right over here. Head over to that 30-minute. What do we notice? Let me remove this order block for now. This candle and this wick, imbalance, right? The body, the close of this candle, the open of this candle and the wick of that candle don't meet, right? So what does that create? Imbalance. Now once we have identified that, we now know when price pulls back, it has to pull back to fill in that imbalance. Now not only is there imbalance, we identify an order block right here, right? An unmitigated order block. So we now know when price pulls back, it will pull back to fill in all of these imbalances, right? As it does, all of these imbalances are now filled and it has mitigated that order block. Does that make sense? And now another example over here. What's this? Imbalance. And now what do we notice price is starting to do? It's starting to pull back. We expect it, this is current price action right now, and I'm looking at this area to then sell off again. So we now expect price to pull back, fill in this imbalance, mitigate our order block, to then continue the move over to the downside. One more example. Euro pound. Head over to that 4 hour. Let's stick to the 1 hour. Now let's go to our initial entry. Why did we enter? It's fairly straightforward, guys. Look. 1, we had that break of structure. 2, what is all of this? From this wick here to this wick there. What's all of that? Imbalance. Now when price pulls back, we expect it to pull back all the way here to fill in this imbalance. But what do we notice up here? A clean order block. An area of demand. So not only do we expect price to pull back into that area of demand, that imbalance, we expect it to mitigate that demand before continuing the move over to the downside. It's fairly straightforward. The understanding of imbalances is clear. All of this here, look, this wick did not meet with this wick, so price pulled back, filled in all of that imbalance. Yeah? This area here, this wick did not meet this wick, so price pulled back. Yeah? This wick here, and this wick and this wick did not meet. It created imbalance. What did price do? It pulled back, filled in that imbalance, and then continued. Right? It's fairly straightforward. Now let me see if I can show you guys one more example. Perfect example right over here. Look. This wick and that wick up here, they don't meet. So what does that create? Imbalance. So what do we know? Price must pull back to fill in this imbalance. And look what it does here. It pulls back, fills in all of that imbalance. And not only does it fill in that imbalance, it comes to mitigate our order block, to then continue the move over to the upside. Does that make sense, guys? Now, look here. Is there any further examples? Here. This wick, that wick, they didn't meet, but this candle here pulled back, filled in that imbalance. Let me mark that out. Wick. Oh my god. This wick to that wick. They didn't meet. So what did this candle here do? Pulls back, fills in all of that imbalance. Yeah? Hope that's straightforward, guys. Let's see if I can find you guys more examples. Euro JPY. Perfect. I'm currently in this trade right now. Now look at this. This wick here and this wick there. They don't meet. What is that? Imbalance. So we now know price will pull back to fill in that imbalance. And what do we have over here? An area of demand, area of supply. Price pulls back into that area of supply, fills in that imbalance, and then continues the move over to the downside. Now, why are we selling off? What do we have here? More imbalance. So price has to pull back, fill in this imbalance. What do we have here? More imbalance. Price has to pull back to continue filling in these imbalances. I hope it's straightforward. Now, in terms of my re-entry, it was on the 3-minute. But why did I take this re-entry? Let me show you guys now. Now, when I sold off here, price broke structure. Once we got that break of structure, I started to look for re-entries. Number 1, we have an order block. Number 2, look at this. Imbalance. We now know price has to come back to fill in this imbalance and mitigate that order block to then continue the move over to the downside. Now, I hope that makes sense. What do we have here? Imbalance. This wick and this wick don't meet. But what happened at this point here? Price pulls back to fill in that imbalance to then continue the move over. I hope that was fairly straightforward, guys. If you have any further questions about imbalances, feel free to message me. But that will be it for this lesson. Now, I'll see you guys in the next lesson. Take care. Today we'll be moving on to chapter 2. I'll be teaching supply and demand. Now look, I don't want you lot to get confused. Now when I was teaching you lot order blocks, remember when I said essentially order blocks are simply areas of supply and demand? Now, what I'll be teaching you in this lesson is the 2 types of supply and demand zones. So we have a continuation zone and we have reversal zones, right? Reversal zones are essentially order blocks. Okay, but let's get straight into it and I hope it all makes sense. So lesson 1. The traditional approach to trading supply and demand. What is supply and demand? Now, when explaining a new term, I always start with a simple definition. Supply equals sell, demand equals buy. Now, of course, it isn't as simple as that, but it's a general idea. An area with increased supply refers to an area with increased selling pressure, whereas an area with increased demand refers to an area with increased buying pressure. Alright, so keywords I want you guys to be familiar with. When I say the word rally, literally all it means is buyers are exceeding the sellers. When I say base, that means sellers and buyers are equal to each other. And when I say drop, that means sellers are exceeding the buyers. Now, this is what I want you lot to pay attention to and understand, yeah? So, the 2 types of zones. Supply and demand zones are divided into 2 types. Before we go any further, let's talk about the 2 kinds of supply and demand zones. Although supply and demand zones are the same thing, they are divided into 2 categories depending on whether they form as a result of a reversal or as a result of a continuation. So, the following are the 2 types. Continuation zones are examples of rally-based rallies and drop-based drop. Now don't worry, I'll be going through live examples of these. And number 2, the second type, reversal zones. Rally-based drop and drop-based rallies. Okay, now essentially when I go through these examples, you guys will already start to click on because these are literally examples of order blocks. These will be examples of continuation supply and demand zones. Okay, now if you lot pay attention to a continuation zone, yeah, these types of zones form when price moves in one direction, consolidates, and then continues in that same direction. So, if you pay attention here, we can see a rally, yeah? Buyers are in power. And then we see a little pause in the market, a little consolidation, right? And then a rally to continue the move over to the upside. Now, that pause, that area of consolidation creates an area of demand, right? So, when price pushes up from there and starts to pull back into this area, that means it would have mitigated an area of demand where we would look to then enter to continue the move over to the upside. That is why it's called a continuation zone, right? Because essentially all it is price is continuing over to the upside. And that's the same for the selling example. We have a drop, and then we have a base, a pause, a consolidation, and then price continues to drop. Now that marks out an area of supply. And now remember I said supply equals sell, demand equals buy. So rally, base, rally. When price pulls back into this area, we know that this is a demand. And what does demand equal? Buy. So we look to buy off demand. Here we have a drop, base, drop. Now when we mark out an area of supply, what does that mean? Sell, right? So when price pulls back into this area of supply, we would look to then sell. Now look at these examples here. So one, we had that break of structure, right? Price broke through this high, creating a higher high. Price then starts to pull back. And what do we have here? A rally, a base, and then a rally. Price pulls back into this demand zone and then continues to move over to the upside. Okay, this is another example. We have a drop and then we have a base, right? And then pay attention here. What's all of this? Imbalance, right? Not only do we have imbalance, we have a base, which marks out an area of supply, right? So now that price created that area of supply, left us that imbalance, we can now anticipate that when price pulls back, number one, it will fill in this imbalance and then mitigate that supply zone to then continue the move over to the downside. Now I hope that was fairly straightforward. Move on to reversal zones. I'm going to be showing you guys quick examples. So first things first, quickly I'm going to go through AN. Now if you lot go back onto the mentals charts, I actually sent this setup, so that's exactly the setup I'll be explaining to you guys now. So first things first is I identified these equal highs, right? Now what happened here? Price took out that liquidity, right? So we now know this liquidity has been taken out. But what do we realize happened right after price took out that liquidity? It shot back down. And what did it do? Break structure. Right now, if I zoom into that structure over here, we can anticipate that price is creating higher lows, right? But then what happened at this point over here? Price failed to maintain its upside presence and it actually broke below that low, right? So we identify this as a minor break of structure, right? So once I got that minor break of structure, right, I started to look for potential areas where I can sell off from. Now, what can we identify here, right? One, we can identify that this is imbalance, right? So we know price has to pull back to fill in that imbalance. But right before this imbalance, what can we see? This nice drop, base, drop, right? And it's much clearer on the 30-minute. So we can anticipate a drop and then a base and then a drop which created imbalance. So price must pull back to fill in that imbalance and it will mitigate off of this very nice supply zone. Right? Now that is where I took my initial entry off. Now if I go back onto the mental section and actually find this out for you guys real quick. AUDNZD right here. Right? So remember, equal highs got taken out. Price then broke that minor structure, pulls back into that supply, right? So if I go back onto the charts, that was the supply. Now look what happened. Boom. Price taps into that supply and it begins to sell off. Okay. Now in terms of setting the TP, we can head over to that 4-hour and look for an area to target. A nice area in my opinion would be this level here. Let's go to that 1 hour, see if we can find better TP. Right, so we can see there's all of this imbalance, right? So we'll target that. Okay, now let's go back to where price was and let price play it out. Boom, we got that further break of structure, correct? Now once we got that break of structure again, let's play price a bit. Not only did we get a break of structure, but what did price leave? Right here. What is this? Equal lows, right? That is all liquidity in the market, right? So we now know price must continue to move over to the upside to take out. that those equal lows. Now, what can we identify at this area over here? A very nice supply zone, right? So one, we had that break of structure. Two, we had that liquidity. Price pulls back into this supply and then continues the move over to the downside. Now we've got that additional break of structure. But what did price create? What is all of that? Imbalance, right? We now know price has to come back to fill in that imbalance and mitigate of that last area of supply. Right, so all of these would be areas to re-enter on. That would have been your second entry right over here. Oh. Right, and we'll be looking to enter again of that supply right over here. Boom. And then price continues his move over to the downside. Now, once we got that additional break of structure, and price reacted, what did it do? Create equal lows again, right? So we can see, look, price is simply creating liquidity so it can seek it and take it out, right? Now this pullback, how could we go in a re-entry? Break down to the lower time frame. Now once we break down to that lower time frame, what can we identify? A drop, a base, and a drop, right? Now before this drop, what can we identify right over here? Another area of supply. Now that would have been another entry point. Alright, head over back to that 1 hour. Move all those TPs down here. And now we let price play out. And that's it. That's current price right now. And I'll still be holding this position, hopefully to target this area over here. And yeah, this is all examples of continuation zones. Now I'm going to move over to reversal zones. Reversal zones. Reversal zones is the same concept as trading order blocks. It literally forms when price reverses direction, then sets off a new swing. So if I go back to that slide, remember I was talking about the examples of reversal zones. Rally, base drops, and drop, base rallies. Now look at this example here. We have a rally, right? Then we have a base. But then price doesn't create another rally. It creates a drop, right? And that drop broke structure. Now that would be a reversal, right? That's why we call them reversal zones. So now that we got that break of structure, and we have that imbalance, right? Probably expect price to pull back, fill in any imbalance, and mitigate that last area of supply. And now this is why I say it's the same concept as trading order blocks. Because look, trading order blocks, you have that last buy to then sell, which breaks structure, right? Price pulls back to mitigate that order block to then continue. Is the same exact thing, right? Same thing here. We have a drop, we have a base, we have a rally. Price breaks that structure, pulls back into that area of demand, and continues to move over to the upside. Now this is an example here. We have a rally. We have a base, right? And then we have a drop. Price pulls back to fill in this imbalance, mitigate this base, to then continue over to the downside. Another example here. We have a drop. We have a base. We have a rally. Price then pulls back, fills in this imbalance, mitigates that demand, and then moves over to the upside. Now, these zones form when one major swing changes to the other. I don't know why it says usually, but it is formed when banks are buying or selling large quantities of the currency. Now, one thing I want to point out is that reversal zones are seen to be the most profitable out of these two types. Now, I'm going to quickly show you guys examples before continuing over to the next lesson. Now, GU. Let's look at the bigger picture, right? Let's repick price here. What can we identify already right over here? All of this imbalance, right? So there is imbalance down here that still needs to be filled, right? Cool. Now, what can we identify at this point over here? So price is creating higher highs, right, and higher lows. Now what can we identify happened right over here? Price broke structure, right? That was that last low, correct? Price broke that structure. And what do we have here? All of that imbalance, right? Now once we identified that break of structure and we identified this imbalance down there, we now know price must come back to fill in this imbalance up here. Look, we have all of this imbalance. Sorry, we have this imbalance right here. Right? That imbalance is now filled. And what can we identify? Right here. An area of supply. We have a rally. We have a base. We have a drop which broke structure. Right? So this right here would be our area of supply. So we would have sold off at this point here. We would have sold off at this point here with our stop loss at the wick, and we'll be targeting that imbalance I was talking about down here. So now if we just zoom out and play price. Price moving over to the downside. There we go. And we hit our take profit. Price filled in that imbalance down here, mitigated our area of supply, filled in this imbalance, and then continued to move over to the downside. And we secured a nice 1 to 14.5. Now let me show you guys one more example. EU. Perfect. Example right here. Price creating higher highs. Price creating higher lows. Right? I've showed you guys this example before. Price creating higher lows. What do we get here? That break of structure. Now when we zoom into price, what can we see? Rally, a base, and then a drop. Now what did that drop do? Break structure. Once we identified that break of structure, we then mark out our base, this whole area here. Right? Now, since I've already taught you guys order blocks, which order block would we go off of? That last buy candle before the sell, right? There we go. We would have sold off at this point over here. And we would have targeted that low. Alright. Now that's entry number 1. Entry number 2. So where's our entry number 2? Let's see. So once we got that break of structure right over here, what can we identify right up there? So we can identify a rally, a base, and a drop which broke structure. And this candle here was the last candle before that sell-off. Price comes to mitigate and continue to move over to the downside. And as you can see, price sold off completely. So I hope reversal zones was quite straightforward. If you guys have any further questions, feel free to message me whenever you'd like. And I'm going to continue over to the next lesson. Alright, now this is the last lesson on supply and demand before we move on to price cycle, I think it was. Yep. But let's get straight into it. So, lesson 2. How to correctly locate and draw your supply and demand zones, and understanding discount and premium pricing. So, how and where do I draw my zone? This is what a lot of you will be asking me. So, once we have identified our base, you may ask, what do we specifically mark out within the base? Do we mark out the entire base? And the answer is simply no. I often like to draw my zones of an indecision candle. An indecision candle is a candle where both buyers and sellers come into power, which leaves a candle with mainly wicks on either side and a small body. Usually the body would be in the center of this candle, and it looks something like this. So notice we have a rally, a base, and a rally, right? Now this is our entire base, right? But what within the base do we mark out? we look for the indecision candle. Now look, these are 5 indecision candles, right? So we look for the one where the body's in the center and has wicks on either side. As you can see, you can identify that right over here. We have wicks on either side and the body's in the center. That would be our indecision candle. Now, look at it play out. So we marked out this. This is our entire base, right? Now, if you took entry of the base, you'd have your entry there and your stop loss there. You would have had a very big stop loss. But as you can see, we identified our entry from this indecision candle. Now, you would have had your entry here, and you could have had your stop loss there, or if you wanted to be safe, you had your stop loss at the bottom of the base. But in terms of entry, you would have entered there at the base, but you would have entered here if you went up the indecision candle. Now look how accurate that would have been. Yeah? So, next question I'll get is, if I identify multiple zones, like this case of it, we have a rally base rally here, but we also have a rally base rally here. So, which zone do I choose? Do I enter there or do I enter there? Now, let me teach you guys how to select which zone you would wait for. Understanding equilibrium, discount, and premium pricing is essential when trading supply and demand. When identifying multiple zones, you go with the zone that is within our discounted levels. Now, how do we identify these levels? To identify discounted and premium levels, you must know how to identify the equilibrium. Equilibrium is the midpoint of a price range, or the midpoint of a swing. It is the level at which an asset is neither cheap or expensive. Therefore, this wouldn't be an ideal level we want to execute a trade of. We want to be buying in at a cheaper rate, which is below the equilibrium, and sell at a premium, which is above the equilibrium. Now, an example of understanding this, right? Say this is the low of a price range, and this is the high of a price range. The midpoint would be your equilibrium, right? Is literally 50% of that price range. Anything above that is classified as premium, and anything below that is classified as a discount, right? Now, these levels can easily be identified using our Fibonacci tool. The levels we are interested in are 62%, 70.5%, and 79%, as all of these are below the equilibrium. For long entries, your Fibonacci has to be drawn from the swing low to the swing high, and the opposite way around when looking to go short. The whole point of buying at a discounted level is to allow the trader to execute their trade at the best price. Now, if we go back to this example again. Now, with the knowledge I have just shared with you guys, which demand zone would I look to take an entry of? Hint, look at the Fibonacci levels. So now that I marked out the swing low and the swing high, we have our Fibonacci levels here. Now remember, 50% is our equilibrium. And what did I say about equilibrium? It is the level, here. It is the level at which an asset is neither cheap or expensive. Therefore, this wouldn't be a level we would want to execute a trade of, right? So this demand zone here is at equilibrium. So we don't want to be taking entry here. We want to look for discounted zones, right? Now look at this zone that I had marked out. That aligns perfectly with our 70.5 and 79%. So now out of these two zones, with what I just taught you, which zone would you go with? This one, right? As it's in a discounted level. So when price pulls back, institutions would be buying at a cheaper price to then push price back up. Does that make sense? So as you can see here, price pulls back to a discounted demand zone and then moves over to the upside. Now I'm going to show you guys a quick example on a couple trades. This one, fairly straightforward, right? Look at this. So we have a drop, we have a base, we have a drop, which broke structure, right? That would have been your break of structure right over here. Let's replay price. So one, we have that break of structure. Two, we have all of this imbalance. So we now know price has to pull back to fill in this imbalance, right? And what do we see right over here? A beautiful indecision candle, right? even cleaner on the 30-minute. So you'd mark out that indecision candle, right? And now we'll wait for price to pull back. Now, you will take out our Fibonacci tool, mark out the high, and we'll mark out the swing low. Now, look at the Fibonacci levels. Does this zone align with the discount? The premium? Yes, it's in our premium level. And remember, we want to sell anything above the equilibrium because it would be at a premium price, right? So now when price starts to pull back, it breaks through the equilibrium. We don't want to be looking to sell yet. We want to sell off a zone that is within our premium range. And we have one that aligns perfectly right here. So we'll wait till price taps into it. There we go. We'll be looking to short from this point here with our stop loss at the wick. And we'll target the low. Or we'll just target this area here. That already marked out. So let's see what happens. And boom. TP hit. Now does it make sense to why I selected this zone? Number one, it broke structure. Number two, we have a clean indecision candle. Number three, this zone aligns perfectly with our discounted Fibonacci level. So this will be classified as a premium supply. So when price pulls back into it, we would look to sell off. Now let me show you guys another example. Euro JPY. This is a trade that hasn't played out fully yet, but we're in the blues. As you can see, only now it's starting to make a move, right? So why did I take entry of this premium supply, right? Now, this is the whole swing point, right? This is the swing high, this is the swing low. Now look at this zone that I have marked out over here, right? Actually, let me go on a clearer chart because it's too much drawing on this one. Sweet. So, number one, price broke this structure. Number two, all of this imbalance, right? So let's actually replay price back to this point here. Okay, so number one, once you get that break of structure, you would fib out the swing high to the swing low. Now you look for your discounted levels, the 62, 71.5 and 79 levels. Now at these discount levels, do you see any zones? We can identify one right over here, correct? So now we'll mark out that zone because it's within the discounted levels. Make sense? Sorry, the premium levels. So this is what we'll classify as a premium supply. So now what would we do? We simply wait for price to pull back into this area of this premium area, which aligns perfectly with this 4-hour supply, and then would look to sell it off. Now as we can see, as price approaches, there we go. We would have sold off here, and this is current price right now. And I'll potentially be looking to target this area of imbalance right over here. So I'll potentially target this whole area here. Entry there with our TP down here. Now does that make sense? Look at our base, right? Very clean indecision candle. Bodies is right in the center with wicks on either side. That's the confluence number one. Confluence number two, we have a drop base drop. Confluence number three, broke structure. Confluence number four, it's in our premium fib level. Right? That's why we took this trade. Another example. Or leave this one out. I'll show you a lot better examples. AN, again, I already showed you guys this example, but let me show you why I specifically chose these zones. So now we're on the hourly, right? Entry number one. Let's pull price back at this point here. So, number one, we have that break of structure. Once we got that break of structure, we notice that there is imbalance, right? This imbalance is now about to be filled. Which zone do we take an entry of? This is our swing high. This is our swing low. So now let's find our discounted areas. Actually, let me go on a fresh chart. Oh, to avoid any confusion. Sweet. Where was it? It was right over here. Cool. Let's just mark everything out quickly. That was the equal highs that got taken out. Right. That was that break of structure. Now once we mark out these, we'll start to look for our entry point. Cool. So again, take out our Fibonacci, mark out the swing high, mark out the swing low. Right? Wick to wick. Now we have imbalance. We already anticipate that price is going to pull back to fill in this imbalance. Now which zone do we sell off from? The ones that is within the discounted area. So we can see the 70.5 and the 79%. We look, we can identify a very nice indecision candle right over here. So now we'll take our rectangle tool, mark our indecision candle, and we'll wait for price to pull back to that zone so we can sell off. Entry number 1, complete. Entry number 2, more liquidity down here. Again, that break of structure, right? Liquidity created down below. Price beginning to pull back. We'll mark out this new price range. So this high to that swing low. And what can we identify with this zone? It aligns perfectly with the 70.5 and the 79%. So that would be another premium supply, right? That would be your entry number 2. Wait for price to react of it. There we go. You've got your entry right over here, and price sold off. Again, what happened right over here? No, wrong tool, sorry. And let's replay price back to this point here. So again, price continued to break structure, but what did it do? Left more imbalance, right? Now we've already anticipated that price is going to pull back to fill in this imbalance, but now we would want to look for a zone to then sell off. So we'll fib out again the new price range. That's the high, and that's the swing low. Right? Look for our discounted areas. We can see this nice candle right here. So this would be our new area of supply. Now we'll wait for price to pull back into it. There we go. Another entry to sell off from. Right? Now for this entry that we identified on the 15-minute, once price reacted of that entry, we identified that price created equal lows, right? Double bottom. And it started to pull back. And there was imbalance, right? So we already know that price is going to pull back to fill in any imbalance. So now we look for areas to then sell off from, right? That's the swing high. That is the swing low. This is the 62, 70.5, 79%. The 62%, we can clearly identify this 15-minute indecision candle right over here, right? So now let's mark that out. With our stop loss right there. And let's wait for price to react of it. There we go, sniper entry. And price continued to sell off. Right? I hope that was fairly straightforward. If you want, I can show you another example. E.g. 4 hour. Actually, let me take out a fresh chart because I already got my drawing on this one. What's going on? Euro GBP. Sweet. Head back to that 4 hour. And let me show you guys why I took this entry. Cool. Alright. Number 1, we had that break of structure. Number 2, we had this liquidity, right? So let's replay price back to this point. So once we identify this breakup structure and this liquidity that needs to be taken out and this imbalance that has to be filled, we know that price is going to pull back and then sell off, right? But where are we going to take an entry from? Step number 1, take out your Fibonacci. Mark out the swing high all the way down to the swing low. And then we begin to look for our discounted areas. 62%, we don't see anything. No base. 70.5%, no base, just imbalance. 79%, what can we see? A discounted supply. So we're interested in this area here, right? So let's go over our confluences again. Number 1, break of structure, minor break of structure. Number 2, liquidity needs to be taken out. Number 3, imbalance that price has to pull back to fill in. Number 4, this premium supply, unmitigated, within our premium level. All of these confluences have been built up. Now we wait for price to pull back to that area of supply, and then we'd look to sell it off. Now, entry would have been off the wick, just like so, and price would have sold off, as it did, right? And let's go for one more example. CAD THF, do we have anything for that? Now, I didn't take a trade yet, but I'm looking at this setup. Why am I looking at this setup? Simple. We have imbalance. We got that break of structure, right? And if we fib it up from the low to the high, what can we identify? A discounted demand, right? And if I head over to that 30-minute, I'm sure I can show you a lot the zone I'm going off with, which is right here. Rally, base, clean indecision candle, and then a rally, right? And we've got this imbalance and that break of structure. That is why I'm looking to take entry of this discounted demand, right? Pound CAD. I already showed you lot this example. NZDJPY. Use DJPY. Wide premiums, perfect. This is an example of a premium supply. Sweet. So we got a rally, a base, and a drop. That drop didn't break structure, but what did it do? Leave us some liquidity. So when price started to pull back and fill in this imbalance, I identified a zone right over here. Okay, now if I fib up the swing high to that swing low, what can we see? This base here aligns perfectly between our discounted levels, and as you can see, price pulled back to this zone and then sold off. Yeah, so now you lot understand how we locate our zones and which zones to select. Simply go off the zone that is in the premium or the discounted level, preferably the ones that align with the 70.5 and the 79%. So again, you guys have any further questions, feel free to drop me a message and I'll help you guys out. Alright, take care. And finally, this will be the last lesson for part 2 before I'll be moving on to part 3, where I'll be going through Wyckoff, and that will be the last chapter to then sum up my entire course. So in this lesson, I'll be going over price cycle, hoping you guys understand it and how we use price cycle as a confluence when taking our trade. Now, I want you guys to draw this out, note it down, as is important, as these are the 4 key phases in price cycle. So we got the consolidation, and then we got the expansion, and then we get the retracement, and then we'll usually get the reversal. Okay, now once you guys drew that out, I would like you guys to note down these bullet points, and the way I'll be explaining it all in order. And these are the 4 points I'd like you guys to write down, the elements of the trade setup. When there's an expansion, you'll notice an order block or a zone is left behind. When price is retracing, is usually retracing to fill in any inefficient price action, and when price reverses, it usually seeks to take out any liquidity, right? And then consolidation, just write equilibrium. That's not really that important, but these are the most 3 important points I want you guys to note down. Now let's get straight into it. What is expansion? It is when price moves quickly from a level of equilibrium. In other words, when price breaks out of consolidation. So this is our consolidation phase, right? Now what happens here? Price breaks through that consolidation. That's what we classify as our expansion, right? When price is just ranging like this, we classify that as a consolidation. When price expands out of that phase, we classify that as an expansion. Now again, equilibrium is 50% of the high and the low of an area that consolidates. So this is our consolidation, this is the high of the consolidation, and this is the low of the consolidation. So equilibrium will be 50% of it. Okay. Now, once price expands outside of this area of consolidation, it will reprice us with an area to execute a position from, so that we can join in on the ride, leaving either an order block or a zone. Now, remember when I told you guys to write down expansion equals order block or zone? Now, notice how price expands out, yeah? When price expands, it usually expands with imbalance, right? So we would expect a retracement back to an order block or a zone that it would have left behind, right? So if you look at this example here, we have a consolidation, right? And then we got that expansion. But notice when the price expanded out of this consolidation phase, what did it create? Imbalance, right? And just before that imbalance, what can we identify right here? A clean indecision candle. Now what does that mark out? A premium supply zone, right? Now I just want you guys to keep that in mind. Now I'm going to go over to retracement. What is a retracement? It is when price pulls back inside the recently created price range. So this is the price range, right? And retracement pulls back within this price range. This is the swing high and this is the swing low. So when price retraces, it retraces within this range. Now, after price expands to either direction, we must look for an inefficient price action created during the quick move. This will then give us an area where we can assume price will retrace or pull back to. Now again, if I go back to this example here, we have that consolidation and then we got that expansion. Now remember what it says in the slide. After price expands to either direction, we must look for any inefficient price action. We got that expansion. Once we identify that expansion, we start to look for inefficient price action, and we identify that right over here, this whole imbalance, right? Now, once we identify that imbalance, we can assume price will retrace or pull back to that area. This then allows us to identify any points of interest where we can set our orders of. Number one, price expands, which may create inefficient price action. As we can see in this example, price expands, it creates inefficient price action. Number two, price pulls back to fill in any inefficiency, to allow both the buyers and the sellers a fair opportunity to liquidate the market. So we identify the inefficiency, and we identify the point of interest where we can look to take or set our orders at or execute a position of. And number three, and then when price comes back to fill in that inefficiency, it will then continue in its intended direction. Now, this is the same example. We had that consolidation, we had that expansion. We identified that inefficiency, so we can already assume price is going to pull back to fill in that inefficiency. We then look for a point of interest where we can look to execute a trade-off, and we identify that supply zone right over here. Price pulled back to the supply zone, right? It fills in that inefficiency. Price has now retraced back to fill in that fair value gap and has mitigated the supply zone. Now let's move over to reversal. What is a reversal? It is when price moves in the opposite direction from what current market direction was moving in. So if it was in an uptrend, it will go from an uptrend to a downtrend, okay? The aim for the reversal is to seek for any liquidity and to take them out, such as trendline liquidity, equal lows, and equal highs. Now, if I go to this example here, 1, consolidation. Number 2, expansion happened, created inefficiency. Number 3, price pulls back to fill in that inefficiency. Number 4, price mitigates that supply zone. And number 3, we get that reversal. And what's the aim for the reversal? To seek for any liquidity. And what can we identify right here? A trend line. And again, in a retail's point of view, they would have bought of this trend line. they would have been in profit, and what do institutions do? Boom, sell price down to take out any stop losses at this trend line. Now do you understand the cycle? Consolidation, expansion. Expansion would leave us an order block, or a zone. As you can see, it left us a supply zone, right? Number 2, retracement. Retracement fills in any fair value gaps, imbalances, inefficient price action. They're all the same thing. The retracement, what did it do? It fills in this inefficient price action. And number 4, reversal, seeks to take out any liquidity. What do we have here? Trend line. And what is that? Liquidity. What did the price do? Seeks to take it out. Now, that is literally all. These are the 4 concepts to understanding price cycle. And I'm going to quickly show you guys examples before I wrap up this lesson. Pound CAD. Why did I take this trade? It is very, very straightforward, guys. Yeah. Now, with the understanding of the price cycle, we know that this is our consolidation phase, right? And then what happened right over here? Price expands. And remember, what did I tell you about expansion? It would leave us some inefficient price action. So that when price retraces, we can assume that it will retrace to fill in this inefficient price action before selling off, right? So we got that consolidation. We then got that expansion. Now remember, once we get that expansion, we look for the order block or the zone that it left behind. And as we can see, we can identify this very nice indecision candle. And what does that mark out? A supply zone. Now the retracement. Retracement seeks to fill in any inefficient price action. This whole candle is the inefficient price action. Price pulls back to fill in this price action. And finally, number 3, retracement. What was the purpose of the retracement? To seek for any liquidity. And now if we head over to that 4-hour time frame, what can we identify? Right, let me replay price to this area over here. What can we identify? Or let's stick to the hourly. What can we identify right here? Very nice trend line liquidity, right? So in a retail's point of view, when price comes to this trend line, what are they looking to do? Buy up again, right? But this is all liquidity. So what's price going to do? That reversal is going to seek to take out that liquidity. So now we head back to that 15-minute. And let's see what price does. Price starts to sell off. Look, it gets the retail traders excited. Retail traders would have bought at this point over here. And then let's see what happens. And there we go. That liquidity has now been taken out. We would have sold here and caught that whole reversal. Does that make sense, guys? So I hope the whole price cycle concept is fairly straightforward. It consists of 4 phases. The consolidation, expansion. The expansion would leave us an order block. The retracement will seek to fill in any inefficiency. This was the inefficient price action that it fills in. And then the reversal seeks to take out any liquidity. And our liquidity was this trend line right over here. Now, next example. USD JPY. Let's look at the 15-minute. Now, this was our consolidation phase, right? Now, once price was consolidating, what happened? It expanded, right? And what did it create? Right here. Liquidity, right? Alright. Now that we understand that, when price expanded, did it create? Inefficient price action. So we know when price is going to pull back, it's going to seek to fill in any inefficient price action. And what do we also identify before this expansion? This very nice zone on the 15-minute. Clean indecision candle, right? So now if I zoom out, this is our consolidation phase, this is our expansion. Price reverses to fill in that inefficient price action, and then we get that reversal. Price mitigates our 15-minute order supply zone, and then seeks to take out, the reversal seeks to take out this liquidity. Now, is it all straightforward? Does that all make sense? Now, if I was to take this trade, I would have entered right here. If you want to be aggressive with your stop loss, you could have had it at the wick of the zone and your TP at the liquidity. You would have caught a nice 1 to 14 risk to reward. But the whole point of this, I want you to understand the cycle: consolidation, expansion. The retracement seeks to fill in any inefficient price action. We have that inefficient price action here. It mitigates our zone. And number 4, the reversal seeks to take out any liquidity. We have equal lows, and the reversal takes out that liquidity. Do you see the beauty of this price cycle? It's very straightforward. Gold. I have multiple examples on gold. Let's play back to the 1 hour. I've already got them drawn out, but let's find them right here. Okay, I'm going to go through 3 examples on gold. Alright, sweet. Let's replay price to this point over here. What can we identify here? A consolidation phase, right? Once we spot our consolidation phase, we wait for the expansion, and we got that expansion right over here. Price expanded to the upside. When price expanded, what did it create? Inefficient price action, right? And it left a very nice demand zone. Look at that indecision candle. Okay, now once price expands, we expect a retracement. What's the purpose of the retracement? To fill in any inefficient price action. We have inefficient price action here. Price has now retraced. It has filled in that inefficient price action. Price has now mitigated the demand zone that was left behind just before that expansion. Price has now mitigated that demand zone. Now, this is the reversal phase. Now, what is the purpose of the reversal? To take out any liquidity. What is this? A trend line, right? So what is this? Liquidity. Now, what's price going to do? Take out that liquidity. The whole purpose of the reversal is to seek for any liquidity. And what's it going to do now? It's going to shoot up to take out that liquidity. Boom. Liquidity has now been taken out. Now, let's move over to the next example. This example right over here. Let's go to the 30-minute. Sweet. So, price was in a consolidation phase. What happened? Expansion. Price expanded outside of that consolidation phase. Now, what did it leave? Inefficient price action, right? So once we got that expansion, we look for the order block just before that expansion, and we can identify that right over here. Oh. Now, once price begins to retrace, we can assume it's going to fill in that price action like it did, and mitigate this order block. Once it mitigates this order block, now this becomes the reversal phase, right? Now, what's the purpose of the reversal? To seek for any liquidity. Now, what can we identify at this point right over here? What is this? Trendline liquidity, right? Put a pound sign on that and mark that out as liquidity. So now we sell off gold to take out that liquidity, and boom. That's crazy, huh? That's the beauty of the price cycle. It will forever repeat itself. So I've been through this example, I've been through this example. I think I skipped this example, didn't I? Yeah, I did. I will go through that now. Let's replay price back to this point over here. And go back to that 30-minute. Alright, sweet. Was it a 15? Find out. Sweet. So, as we can identify here, what is this? An area of consolidation, right? After this area of consolidation, what happened here? Price expanded. And once it expanded, what did it create? Inefficient price action. Just before this expansion, we identify a very nice area of demand right there. Correct? So let's head over back to that higher time frame. Look at the zone we went off. You see this 1 hour clean indecision candle? Body's right in the center, wicks on either side. Right. So we have now identified the consolidation phase. We identified the expansion. Now, what did price create up here? Equal highs. Now what's equal highs? Liquidity, right? So now we know when price is retracing back to fill in that inefficient price action, and it mitigates our demand zone, we now know the reversal is going to seek to take out these equal highs. So let's see what happens. It didn't take out the liquidity, but essentially when it comes to setting the TP, you would have targeted those highs. So you would have entered right here with your stop loss, either at the close of the wick, or you can have it a few pips below, depending on how aggressive you are. and your TP would have been that high. Let's see what happens. Price that would have hit your TP, and then that price cycle is what I went through already with you guys. So that was the consolidation phase. Price expanding out of the consolidation phase, pulls back in, creates that trend line liquidity, and then mitigates that order block, and then boom, melts. So I hope that was fairly straightforward with you guys. Any further questions, feel free to message me, but make sure you backtest this cycle. You will find it playing out at least 80% of the time. Right? Alright guys, take care. Alright, I hope you're all doing well. I know I haven't posted a video on the course for quite a while, but I thought this video was necessary for quite a lot of you, as many of you understood the concepts but you weren't able to piece the puzzles together. So what I'll be doing is I'll be going through Euro USD, and I'll be starting off from the weekly and breaking down onto the lower time frame and showing you guys how I would approach the markets. So let's get straight into it. Now if I just head over to TradingView real quick, and I already have EU open. Now the first thing I'll do is mark out my areas of supply and demand, right? And I'd mark out the price cycle. On every single time frame I approach, I'd mark out the price cycle, okay? Because the cycle plays out on every single time frame. And I personally like to trade between supply and demand, right? So the first thing that I can clearly identify is that price has reacted of this weekly supply right over here. Right, we can clearly see some rejections at this point over here. Now once we got some rejection, the price started to pull back. We can see that it started to pull back into an area of demand that was created right after this impulsive move. Now again, remember I told you I identified a price cycle on every single time frame. So we can clearly identify a nice price cycle right here. We have this area of consolidation right here. Price broke out of this area of consolidation and expanded to the upside. So we'll call that a change in character. Right. Now we know price is in a bullish sentiment. Now once price moved over to the upside, it has now reacted of an area of supply right over here. That's when price started to move over to the downside. We saw some retracements down to a nice demand right over here. Not only did it react to this demand, but also filled in some imbalance that was here, and there was a gap created right here. And we know when a market creates a gap like this, it must come back to fill in that gap. And as you can see, it did come back and it filled in that gap and mitigated off this weekly demand right over here. Now once I have that marked out, I then head over to the daily time frame. Now what can I see on the daily time frame? You know what, first let me replay price back to this point over here. Now what can I see? Once price reacted of this area of supply, what did it start doing here? Distributing orders, right? So essentially this is an area of consolidation. So I'll have that marked out. And now let's zoom in a bit, right, into this area. Once price expanded over to the downside, we can see that there's some imbalances that was left, right? So let's mark out the last area of supply before that move over to the downside. So essentially this is a nice area of supply that we have on the daily, right? So let me zoom out a bit. Let me extend that area of supply. So now I know that price is approaching this area here. So what I'll simply do is wait for price to tap into this area before I start to make any decisions. I want to see how price reacts at this point, right? So let's continue to play price and watch how it approaches that area of supply. And remember the price cycle again, yeah, consolidation, expansion. We had some imbalance there that needs to be filled. Price retrace to fill in this. It's starting to go towards this area of imbalance and this area of supply. So now what we're going to want to do, we're going to want to short to catch that reversal. And now what do we have here again? Another area of consolidation. So we now know when we come to sell off from this area, we can target an area of demand anywhere here. And I can already identify one At this point we have some nice imbalance here, and that was an unmitigated area of demand right here. So when price reacts of this level, I'll be looking to short potentially to this area over here. Now let's play price. Wait for it to tap in. There it is. Alright, let's replay price back to when it actually tapped. Now we head over to the 4 hour. Notice something, yeah? As price is approaching this zone, it's starting to weaken. Notice how the move isn't impulsive anymore. It's very weak as it approaches this zone. This is a good sign, right? Now if I take out my RSI, what can we see? Price is creating higher highs, right? But then when you look at the RSI, what's price creating? Higher lows, right? Sorry, not higher lows. Lower highs. I know it's a bit late, I'm a bit sleepy. So it's creating lower highs, right? So we have some lower highs here and some higher highs being created here. Now that's a strong sign of a reversal. So that's one confluence, right? Now let's wait for price to actually tap into that zone. There it is. Now once price has tapped into that zone, we head over to the 1 hour time frame. Now let's get rid of our RSI. Sweet. So now that price has tapped into that area of supply that we had marked out on the daily, we still don't want to enter because our stop loss will be way too huge, right? Now if we entered, our stop loss would have been 60 pips. We don't want to do that. We want to wait for a lower time frame confirmation entry, right? Now on the hourly, I would personally like this structure to be broken before I look for any sells, right? We can head up, let's stick to the 1 hour for now. Would want this structure to be broken before we start to look for any sell positions, right? Because we don't want to be selling from here with a 60 pip stop loss. So now let's continue to play price and wait for that breaker structure. Now, as you can see, price wicked out and broke that structure. Once we got that breaker structure, notice how price created an area of, it's created some inefficient price action. We've got some imbalance right there that we know that needs to be filled in. So once we got that breaker structure, once we got that breaker structure, we have identified that price left over some imbalance. So price now must be retraced to fill in that imbalance and potentially mitigate of this area supply. Now, what we can do is not necessary, but now we take out our fib, mark out that price range from the high to the low, and we clearly identify this nice hourly supply that aligns perfectly with the 79%. So now I would mark out this 1 hour area of supply. And now what I'll do is break it down. I'll head over to the 30 minute and see if I can refine it to anything. We can go off this candle. 15 minute. Beautiful. That would have been the last candle before that move over to the downside. And I'll set my stop loss at the top of that move. So I'd potentially enter up that 15 minute. Let's head over to the 5 minutes, see if we see anything. Oh shit. Data point unavailable. Oh, for fuck's sake. Alright, let's replay price back. No worries. Play back here. Head over to the hourly. Alright, sweet. So as I was saying, we were on the 15 minute. We can't go into the 5 minute because the data is unavailable apparently. So we'll just stick to that 15 minute. Let's refine it to that wick. And let's still have our set our stop loss of the hourly. Sweet. So that would have been our entry, right? So now I would wait for price to pull back into that area for us to then look for sells. Now where would we be targeting? Remember I was talking about that area of consolidation on the daily. This area right here. Now we look for any imbalance. First of all, let's identify the liquidity, right? Let's get rid of that divergence. What can you spot over here? Trend line, right? Price is respecting this level here. It's respecting it all the way. And what does that build? It builds liquidity, right? What do we know that? Okay, so let's go back to the price cycle, right? Let's head over back to that weekly. Remember the objectives, guys. Yeah, consolidation, expansion. Okay, the objective of the expansion is to break structure. We've got that break of structure right here. Now, what's the objective of the retracement? The objective of the retracement is to fill in any imbalances, right? And we have that imbalance right here that's about to be filled in. Now, the reversal is about to happen. And what's the objective of the reversal? The objective of the reversal is to seek liquidity to take it out, right? Now, if we head over back to that 1 hour again, what have we identified here? Liquidity, right? And now we know we're in a reversal phase. And what's the objective of the reversal? To take out any liquidity, right? So that was another confluence for us to take that sell. We have some sell side liquidity here, and we have some imbalance at this point over here. So now when it comes to setting our TP, you can either TP here or TP here, but I'll be TPing, taking profit at this point here to be safe, right? So now we're shorting off of that 15-minute supply that we have marked out, and we'll be targeting that imbalance down over here. Now that's how I would personally approach every single pair, any market, no matter what the asset class is. That's how I would break it down. I'll start off with a higher time frame, mark out any structural breaks, mark out any supply and demand areas that has already reacted off. Then I'd mark out the price cycle. I'd mark out the areas of consolidation, the areas of expansion, and any imbalances that allows me to identify areas of supply and demand on the lower time frame. As price taps into the higher time frame supply and demand, I won't take a position. I'll wait for some lower time frame change of character. So at this point over here, that would have been our change of character, right? Because price was printing higher lows, but then what did it print right here? A lower low. It didn't sustain its upside. It broke through that low. That's what we call a change of character. Once I identify that on the lower time frame, then I would look for my entry. And as you can see, we found one on that 15-minute. So now let's play price and let's see what happens. There it goes. Price has now tapped into our area of supply. We're in sells, and we'll be targeting that imbalance down here. And there it goes. It's as simple as that. That's how I personally like to approach any pair. Mark out the price cycle. On the higher time frame, mark out my areas of supply and demand, wait for a reaction of the higher time frame areas of supply and demand, and then wait for a change of character on the lower time frame. Then I'll get in on that confirmation entry. Okay? And remember, guys, you have to remember what phase you're in. Make sure you're identifying whether you're in a retracement phase or you're in that reversal phase. Because when you identify the phase that you're in, you understand the objective of you understand the objective of where price is heading. So because we identify that we're in a reversal phase right now, remember, what's the objective of the reversal? To seek liquidity. So now that we know we're in a reversal phase right here, we then start to look for liquidity areas, because that gives us a confluence to short. We have identified our liquidity area right here. So now we know that when price reverses, it's definitely going to seek this liquidity. So that gives us a confluence to short. Not only because we've got a change of character, but also because there's liquidity that we know the reversal is going to seek. Alright guys, I hope that was very straightforward. So as you can see, price has hit our take profit and filled in that imbalance. Could have secured a nice 1 to 25 risk to reward on this trade. Feel free to message me if you do have any questions, and I hope you lot enjoyed this video. Take care. Alright, what is going on, my people? Hope you're all doing well. Now, I thought I'd just make a quick video on how to stack your trades and basically how to enter multiple positions on a winning setup. And let's get straight into that video. So, to properly stack trades, you must be able to identify structural breaks and changes of characters, yeah? Properly. This was taught in the first lesson on market structure. Now, I know when I was teaching market structure, I was simply calling them continuation break of structures and reversal break of structures. But just to remove the confusion between the two, right? We call this exchange of character. So simply when price is moving in an uptrend and in a break structure to the downside, we call that a change of character, right? Because it simply changed from an uptrend into a downtrend, okay? So here we have an example of a bullish breaker structure. As you can see, price is continuing to break the high, continuing to move over to the upside. In this case, we had an uptrend right here, and then boom, price broke below that low, and that's what we identified as a change of character. Now once we get that, that's when we start to look for a supply zone to then continue the sales over to the downside. Whereas in this example, when price breaks the high, we then identify a demand zone and wait for price to pull back into that demand zone to continue the wave over to the upside. But now let me show you guys an example that I have on GJ. Now let's take a look on GJ, right? First, let's head over to the 30-minute. And what can we identify? So ignore all of this. Let's focus on our supply and our demand levels, right? Here we clearly have a very nice indecision candle, right? This was the last candle before price broke structure, yeah? That was our supply zone. Now, I don't know if you lot remember, but I sent in the Discord this supply zone, and I told you guys to monitor this position. Now, I didn't monitor it either. I can't lie to you guys. I was simply watching gold at the time. However, if you were to monitor it, you could have gotten all of these positions here and all of these positions here, right? But anyways, so we had this supply zone marked out. We waited for price to tap into this supply zone before we made any decision. Now we also have these demand zones marked out, right? We have this demand zone here, we have this demand zone here. So anyways, let's zoom into this area right here, right? Let's break into the 5-minute. And then we look at how price reacted here. Alright, sweet. So, remember guys, to be able to stack positions correctly, you have to make sure you're able to identify the changes of character and the breaks of structures in the markets, right? So, once price tapped into this 30-minute supply zone, we didn't take sell straight away. I had up there, I'd like to wait and see how price plays within the zone, right? So once we got that reaction, we wait for a change of character. Now on the 5-minute, we have this low, that low. Once the first low is broken, that is what we classify as a change of character. It shows some willingness to change direction over to the downside, right? So once we identify this change of character, you could have gotten at this area of supply right here. Yeah, we have a very nice order block on the 5-minute. But then that order block can be refined, which I did on the 3-minute. Now if we head over to the 3-minute, what can we see? Look at that. You see this indecision candle right here? The body lies in the center and wicks on either side. However, you'll set your stop loss at the wick above here, right? So we took entry of this and we set a stop loss right there. Alright, but now let's remove replay mode and move over to the next position you could have stacked your trade in, right? So once you got that change of character, you could have gone at this area of supply right here. Now you wait for a breaker structure, right? You wait for this low to be broken to continue to stack in another entry. So once this low was broken at this point over here, we can then identify a nice area of supply right here, right? So if you mark out this area here and you mark out this area here, this is a bit more aggressive. I would allow your stop loss to have a bit more room and target this place here. So you set your stop loss right there and your entry right over here. So that would have been your second entry. And then we got another break of structure. Price continued to break that low. Now we have confirmed that we're in a downtrend, right? Because we had a break of structure here and another break of structure here. Now we identified this nice indecision candle that lied here. That was the last candle before this expansion which broke structure. Now we marked that out. Price then pulled back, as you can see. Let me remove this for now. Price pulled back into that area of supply. Stop loss at the wick, entry at the wick as well, and then we ride the move over to the downside. And now, remember the demand zones we had marked out, that would be your take profit points. So if we pull price back here, we had that first area of demand. So you could have gotten these three positions. This one was a 1 to 10, this one was a 1 to 13, no, this one was a 1 to 9, and this one was a 1 to 13. So you're going to capitalize very nicely off this one move right here, taking profit at this demand. Now, back to the 5-minute. Now, once you take profit on these three positions, we wanted to wait and see how price reacts of this demand. Now, as you can see, we didn't get any reaction. Price simply went through that area of demand. So now we ignore this area of demand, right? As it's not valid anymore. Price simply broke straight through it. So it's not valid. But then price continued to move over to the downside and tap into this area of demand, right? Now, once we start to see some rejections of this area of demand, we wait for a change of character, okay? Now, as you can see, that was the lower high, and then we got an even lower high, right? And then once price reacted of this supply, we got that change of character right here. That lower high was broken and now created a higher high. So now we confirm that this last sell was the last sell before that change of character. So now this is our new area of demand that we're interested in. So now we wait for price to pull back into this area of demand, and then we look to go long, okay? And then you can simply target this area. Look, we got this imbalance right here, and we got this nice area of demand right over here, okay? See that? We got this imbalance and that nice area of, supply, yeah? So, once price taps into this higher time frame area of demand, we wait for that change of character that we got right there. Then we mark out the last demand zone before that change of character. Price pulls back into it. We could have got our entry right here, okay? And then when price broke this high, I was looking for this entry right here, but as you can see, price didn't come to it. It came to this area of demand instead. But anyway, so that would have been a missed entry. And then price broke, I don't know why I have it marked up here, but price broke this structure right here, yeah? Once we got that break of structure, we identified this very nice area of demand, okay? Price broke structure, pulled back into this area of demand, and then we could have went long here as well. And then what happened here? Price broke this high, break of structure. We also have some imbalance that needs to be filled in. So price pulls back, fills in that imbalance, and mitigates of this last area of demand. So this would have been your third entry point right here. And then again, this structure broken, right? This was the last candle before that break of structure, and as you can see, this was the last candle, and then we had imbalance right after. So we know price is going to come back, fill in this inefficient price action, and mitigate of this last area of demand. Now, if we look at the price cycle, this was our consolidation, expansion, retracement to fill in the inefficiency, and then reversal. Okay. Now, again, we had that area of supply marked out, but as you can see, once price pulled back and we went long here, price broke right through it. So now this area is no longer interesting to us. Now this structure was broken, and again, we want to continue the wave over to the upside because price hasn't broken any lows yet. Once a low is broken, then that would be a change of character, then we'll look to go short. But at this point over here, it reacted of this demand and now starting to move over to the upside again. Alright? So that is very straightforward. This is simply how you'll stack your trades. You'll simply mark out your higher time frame supply and demands, wait and watch how price reacts to the zones. You wait for a change of character. Once you get that change of character, then you mark out your areas, your new areas of supply and demand. Okay, so as you can see here, that was our area of demand. That was the last candle before that change of character. So you wait for price to pull back, mitigate that candle to ride the move over to the upside. This is how you maximize your risk to reward rather than entering on the higher time frame zones. If you entered here, okay, you could have went long here. I'm not saying you couldn't. You could go long here, but then look at the difference. You would have a 10 pip stop loss, and your TP would have been right there as well, right? I'm just showing you the difference between an aggressive entry and a confirmation entry. Here you would have had a 10 pip stop loss, same TP, and your risk to reward would have been 1 to 7. Whereas if you waited for a confirmation entry like this one, you would have got a risk to reward of 1 to 20 with a 3 pip stop loss, right? So that's how you'd stack your positions. You would wait for price to tap into a higher time frame zone, wait for a change of character. Once you get that change of character, you mark out the candle before that change of character, and in this case it was right here, right? And then you wait for continuous structural breaks. As you can see, this structure was broken. We look for the areas of supply and demand. In this case, we had a nice demand zone before that structural break right here. Price pulled back into it, went long again. This high was now broken. Imbalance was created. This area of demand was unmitigated. Price pulls back into it, mitigates to continue the wave over to the upside. It's very straightforward. This high was broken. We had some imbalance here. Consolidation. Price pulls back, fills in the inefficient price action, taps into this unmitigated area of demand, and continues to move over to the upside. It's very simple and straightforward, guys. There's nothing to it. Same thing for the sells. Price tapped in here. We waited for that change of character. There was that 3-minute zone that we had marked out was unmitigated. We could have sold off here. This structure was now broken. Shows continuation of the move over to the downside. We had this unmitigated buy to sell. Price taps into it, sells off. Again, break of structure right here. Price pulls back, taps into it. It was a 3-minute zone. Price taps into it and then sells off. It's very straightforward, guys. And this is all it takes for you to stack positions into a winning setup. You wait for that reaction of the lower time frame. Okay, wait for that change of character. Mark out your new zone, and then you'll go long or short from there, depending on the sentiment that the market is in. I hope that made it very straightforward for you guys, and I hope that did help a lot in terms of how to re-enter in the market, how to find just simply how to stack more positions into your trade to maximize the percentage or gains that you can get from each setup. Alright, I hope you lot enjoyed this video. Take care.